Before we begin, please note that the information provided in this video is for educational and informational purposes only. It does not constitute financial, legal, or insurance advice. I am not a licensed financial advisor or insurance agent. You should always consult with a qualified and licensed professional before making any decisions about your insurance coverage. Your individual circumstances are unique, and the information presented here may not be applicable to your specific situation. That letter hits your kitchen counter with a thud. You know the one. It's got the logo of your car insurance company on it, but it feels heavier than a normal bill. Your heart starts to pound a little faster. You rip it open, and there it is in cold corporate font. "We regret to inform you," or "Notice of non-renewal." And just like that, the floor drops out from under you. You've been canceled, dropped, kicked out of the club. Your mind races. How am I going to get to work? How will I take the kids to school? Driving without insurance isn't an option. It's illegal, it's reckless, and the financial consequences could ruin you for life. So you do what anyone would do. You scramble. You go online, frantically typing in your information into all the big-name insurance websites, the ones with the funny commercials and the catchy jingles. And then the second wave of bad news hits. Quote after quote comes back astronomically high. We're talking 2, 3, even 4 times what you were paying before. Or worse, you get a flat-out rejection. Based on the information provided, we are unable to offer you a quote at this time. It feels like every door is being slammed in your face. Feels personal. Feels unfair. And you're left wondering, what on earth did I do to become so untouchable? I'm here to tell you, you are not untouchable. You're not uninsurable. You have just been kicked out of the preferred club and unknowingly entered a completely different world of car insurance. It's a world most people don't even know exists until they're forced into it. It's called the non-standard market. And understanding this market is the single most important key to getting you back on the road, legally and without going broke. In this video, we are going to pull back the curtain on this hidden side of the insurance industry. We're going to talk about what non-standard insurance actually is, why you might have been pushed into it, and how companies like Direct General Auto Insurance have built entire empires catering to this exact market. This isn't just information. This is your roadmap. This is your guide to navigating a system that feels designed to confuse you and take your money. By the end of this, you will understand the game, you will know the players, and you will be empowered to find the best possible coverage, even when it feels like no one wants to cover you. So what is this invisible line you've crossed? Think of the auto insurance world as being divided into 2 major categories. The first is the standard or preferred market. This is where the big household names live. State Farm, Geico, Progressive, Allstate. These companies spend billions on advertising to convince you they're for everyone. But they're not. They are incredibly selective. They are in the business of insuring low-risk drivers. They want the person who has a perfect driving record, a credit score over 750, who has been continuously insured with the same company for a decade, and who bundles their home and auto insurance. They want the person who is statistically the least likely to ever cost them a dime. If you fit that perfect mold, congratulations. You get access to the best rates and the smoothest service. But what happens if you're not perfect? What if you're a normal human being who makes mistakes? That's where the second category comes in. The non-standard market. This isn't bad insurance. It's just different. It's a specialized market designed for drivers that the standard companies consider high risk. The term high risk sounds scary, but what does it actually mean? It's a label an insurance company gives you based on a complex calculation that says you are more likely to file a claim than their ideal customer. And the reasons you can get slapped with this label are far more common than you might think. Let's break down who the non-standard driver really is. Maybe you recognize yourself in one of these profiles. First, you have the driver with a spotty record. This is the most obvious one. A few speeding tickets, a texting while driving violation, or an at-fault accident in the last 3 to 5 years. To a standard insurer, that's a red flag. They see a pattern, and their algorithm screams risk. Even one at-fault accident can be enough to get you non-renewed and pushed into the non-standard market. Second, the driver with a lapse in coverage. This is a huge one that trips up so many people. Maybe you sold your car and didn't buy a new one for 6 months. Maybe you were struggling financially and had to let your policy cancel for a couple of months. To an insurance company, an uninterrupted history of coverage is proof of responsibility. When they see a gap, no matter the reason, they see unreliability. They don't know what you were doing in that time, and they assume the worst. A coverage lapse, even a short one, can instantly disqualify you from preferred rates and push you straight into the non-standard category. Third, and this is the one that shocks people the most, the driver with a low credit score. You're thinking, what does my credit card debt have to do with my driving? In the eyes of over 95% of auto insurers in the United States, it has everything to do with it. They use a special insurance score that is heavily based on your credit history. Their data, they claim, shows a direct correlation between how a person manages their finances and how likely they are to file a claim. Is it fair? That's a massive debate. But is it a reality? Absolutely. A low credit score, even with a perfect driving record, can land you a quote that is double or triple what someone with excellent credit would pay, and it can be the sole reason you're considered non-standard. Fourth, you have the new driver. It doesn't matter if you're a 16-year-old who just got your license or a 40-year-old new immigrant who just started driving in the US. If you have no established driving history, you are a complete unknown. And insurance companies hate unknowns. To them, no history is just as risky as a bad history. You haven't proven you can be trusted behind the wheel, so they place you in the high-risk, non-standard bucket by default until you can build up a track record. And finally, you have the most serious category, the driver who needs in-state Route 22 or has a major violation on their record. This is for things like a DUI or a DWI, getting caught driving without insurance, or having your license suspended. And State Route 22 isn't actually insurance. It's a certificate that a non-standard insurance company files with your state's DMV. It's basically a guarantee from the insurance company that you are carrying the state-mandated minimum liability coverage. If you cancel your policy or miss a payment, that company is legally required to immediately notify the DMV, which will likely result in your license being suspended again. If you need in-state Route 22, you are automatically 100% in the non-standard market. The preferred carriers won't even touch you. So if you fall into any of these categories, a ticket, an accident, a coverage gap, bad credit, no experience, or a major violation, the standard insurance world effectively closes its doors. But another one opens. This is where companies like Direct General, the General Safe Auto, and a host of others come in. They are not trying to compete with State Farm for the perfect customer. Their entire business model is built around serving the non-standard market. They are specialists in pricing risk. They understand the profiles of these drivers, they know the state laws inside and out, especially when it comes to things like SR22s, and they've created a process to get you covered, often on the same day. They are the lifeline when you feel like you have no other options. But this lifeline comes at a cost, and it operates with different rules. Understanding those rules is the key to not just getting a policy, but getting one that actually protects you without draining your bank account. So let's pull back the curtain on those rules. The single biggest difference between a standard insurance company, think of the big names you see advertising during the Super Bowl, and a non-standard company like Direct General, is how they look at one simple thing: risk. Your standard Geico, Progressive, or State Farm has built their entire multi-billion-dollar empire on a model of avoiding risk. They want the perfect driver, the 45-year-old with the spotless driving record, a great credit score, a sensible sedan, who lives in a safe suburb and has been continuously insured since they were 16. They use complex algorithms to find these people and offer them competitive rates because statistically they are a safe bet. They are unlikely to cost the insurance company money. Non-standard insurance flips that model on its head. They don't avoid risk. They embrace it. They specialize in it. Their entire business is built to absorb the drivers that the standard market has rejected. They have become masters of pricing risk. While a standard company sees a driver with a DUI and their algorithm screams deny, a non-standard company's algorithm says, accept, at a price. They are the financial first responders for drivers who have been labeled high risk. But what does that label, high risk, actually mean? It's not a moral judgment. It's a cold, hard statistical calculation. And you might be surprised what can land you in that category. The most obvious one, of course, is your driving record. A DUI or DWI is the nuclear bomb of driving infractions. It automatically puts you in the non-standard market for years. Multiple at-fault accidents in a short period send up a huge red flag. A collection of speeding tickets, a reckless driving charge. These are all clear indicators to an insurer that you are, statistically, more likely to be in another accident, which means you're more likely to cost them money. Think of a guy like Marcus, a 28-year-old contractor, great guy, works hard. One night he goes out with friends, has a couple too many beers, and makes the terrible decision to drive home. He gets pulled over. Suddenly, his life is turned upside down. On top of the legal fees and court-mandated classes, his standard insurance company drops him like a hot potato at his next renewal. They send him a letter that basically says, "You are no longer the kind of customer we want." Marcus still needs to drive to work to make a living. He has to get insurance. He's now a non-standard customer, not because he's a bad person, but because he made one catastrophic mistake. But it's not just about what happens behind the wheel. One of the biggest and most controversial factors is your credit score. You might be asking, what in the world does my Visa bill have to do with my ability to merge onto a highway? To insurance companies, it has everything to do with it. Decades of data have shown them a strong correlation. People with lower credit scores tend to file more claims. Not just more at-fault accident claims, but more claims of all kinds, comprehensive claims for theft, vandalism, or weather damage. The industry's logic is that a person's financial responsibility is a predictor of their overall responsibility, including how they maintain and operate their vehicle. Whether that's fair or not is a massive debate, but it is the reality of how the system works. A low credit score can push a driver with a perfectly clean driving record into the non-standard market. Then there's the lapse in coverage. This is a trap that catches so many people. Maybe you sold your car and didn't buy a new one for a few months. Maybe you hit a rough patch financially and had to let your insurance go for a little while. To an insurer, that gap is a chasm of unknown risk. They don't know what you were doing. Were you driving uninsured? Did you just forget? It doesn't matter. A lapse in coverage breaks your history of continuous insurance, which is a golden ticket in the standard market. When you try to get a new policy, even a 30-day lapse can be enough to shunt you over to a non-standard provider and a higher premium. It's like a trust exercise, and by letting your coverage drop, you've broken that trust in their eyes. Of course, the car you drive matters too. If you have a high-performance sports car, something that's built for speed and is expensive to repair, you're a higher risk. The same goes for a heavily modified vehicle or a car with a salvage title. And then there are factors you can't control, like your age. A 17-year-old male driver is statistically one of the riskiest clients on the planet, and will almost always start in the non-standard or a high-risk tier of a standard company. But the real entry point for millions of Americans into this world is a little piece of paper called In-State Route 22. In-State Route 22 isn't actually insurance. It's a certificate, a form that your insurance company files with the state DMV on your behalf. It's basically your insurer telling the state, "We guarantee this person has at least the minimum required liability insurance." You're typically required to have In-State Route 22 after a major violation like a DUI, driving without insurance, or having your license suspended. It's the court's way of putting you on a probationary leash. And here's the kicker. Most standard insurance companies won't file In-State Route 22. They don't want the hassle or the associated risk. So, if a judge tells you that you need In-State Route 22 to get your license back, you are almost automatically forced to shop in the non-standard market. Companies like Direct General have built a core part of their business around servicing State Route 22 clients. So you've been labeled high risk for one or more of these reasons. What does that actually mean for your wallet and your policy? This is where we get to the real cost. The most obvious cost is the premium. It's going to be higher, sometimes significantly higher. A driver in the non-standard market could easily pay double, triple, or even more than a comparable driver in the standard market. That price is a direct reflection of the risk the company is taking on. They expect to pay out more in claims for their pool of customers, so they have to charge more to stay profitable. But the sticker price is just the beginning. The differences run much deeper. Non-standard policies often come with very limited coverage options. While your standard insurer might be trying to upsell you on things like rental car reimbursement, roadside assistance, or new car replacement coverage, a non-standard policy is often stripped down to the bone. The primary goal is to get you the state minimum liability coverage you need to be legally on the road, and nothing more. Getting robust, high-limit coverage that truly protects your assets can be difficult or prohibitively expensive. They are selling legality, not necessarily comprehensive peace of mind. The structure of the policy is different, too. You'll likely face higher deductibles. That's the amount of money you have to pay out of pocket for a claim before the insurance company pays a dime. If you have a $500 deductible and a $3,000 repair bill, you pay the first $500. Non-standard insurers might require deductibles of $1,000, $1,500, or more. This shifts more of the initial financial burden onto you, which in turn reduces their risk. And then there are the fees. This is the hidden part of the cost. The payment plans can be much more rigid. While a standard company might let you pay monthly with no fuss, a non-standard provider might demand a much larger down payment, sometimes 20 or 30% of the total 6-month premium upfront. They want more money in hand from the start because they see you as a higher risk for non-payment. On top of that, you'll often find a list of extra fees: policy initiation fees, monthly billing fees, reinstatement fees if you're ever late on a payment. Each one might seem small, but they can add up, turning a quoted monthly premium into a much larger monthly expense. It's a business model designed for a clientele that is often living paycheck to paycheck, offering a low entry point but building the cost back in through a dozen smaller cuts. Feels like a trap because, in many ways, it is. You're in a tough situation, you need a car to survive, and this is your only option. You're paying more money for a lesser product with stricter rules, all because of a mistake you made, a financial hardship you endured, or sometimes just because of your age or zip code. But inside this system, a handful of companies haven't just survived, they have become giants. They've perfected the art of insuring the uninsurable. Companies like Direct General. But how do they actually do it? Is their business model a benevolent service for those with no other options? Or is it a machine perfectly tuned to profit from their difficult circumstances? The answer reveals the hidden engine driving the entire non-standard industry, and it's far more complex than you might imagine. And that complexity begins not with the drivers but with the business model itself. To understand a company like Direct General, you have to stop thinking about car insurance the way you see it on television commercials. Forget the friendly geckos or the quirky sales associates in their pristine white aprons. The non-standard insurance world operates on a completely different set of principles, driven by a different kind of math. It's a high-wire act of financial engineering, and the entire platform rests on one single foundational pillar: state-mandated minimum liability. Every state, with the exception of New Hampshire, legally requires drivers to carry a certain amount of liability insurance. This isn't for your protection. It's to protect everyone else from you. If you cause an accident, this insurance is supposed to pay for the other person's car repairs and medical bills, up to a certain limit. And those limits are, in most states, shockingly low. We're talking $25,000 for bodily injury to one person, $50,000 total per accident, and maybe another $25,000 for property damage. That's a common formula, often written as 25/50/25. To a standard insurance company like State Farm or Allstate, these state minimums are just the starting point. They want to sell you higher limits, comprehensive coverage for your own car, uninsured motorist protection, and a dozen other products. Their ideal customer is someone who bundles home and auto, has a great driving record, and pays for a thick blanket of financial security. But for a non-standard insurer, the state minimum isn't the starting point. It's the entire game. Their core product isn't peace of mind. It's a piece of paper. It's the proof of insurance card that lets you legally drive your car off the lot, that you hand to a police officer if you're pulled over, that keeps the DMV from suspending your license. They are selling legal compliance first and foremost. Everything else is secondary. This is the single most important distinction, and it explains everything that follows. So, the first part of the profit equation is simple. They aren't selling a comprehensive, protective product. They are selling the most basic, stripped-down version of a product that the government forces people to buy. This allows them to manage their potential payouts. If the most they'll ever have to pay for property damage in a given state is, say, $25,000, their maximum exposure on any single claim is capped at a relatively low number. They aren't on the hook for a brand new $60,000 SUV. But that's only half the story. How can they make a profit when their entire customer base is, by definition, considered high risk? The premiums are, of course, incredibly high. A driver with a DUI and a poor credit score might pay 4, 5, or even 10 times what a standard risk driver pays for the same bare-bones coverage. But even those high premiums might not be enough to cover the increased likelihood of accidents. The real genius, from a business perspective, lies in how they structure the payments and handle the claims. Let's talk about payments. Most customers in the non-standard market can't afford to pay a 6-month or year-long policy in full. They need to pay month to month. Standard insurers often allow this with little to no fee. But in the non-standard world, the monthly payment plan is a massive profit center. You're not just paying your premium. You're often paying a steep initial down payment, followed by monthly installments that include hefty service fees or finance charges. In essence, the insurance company is also acting as a high-interest lender, financing the purchase of its own product. Over the course of a year, a customer could pay hundreds of extra dollars just for the privilege of paying monthly. That money has nothing to do with their driving risk. It's pure profit, generated from the customer's tight financial situation. Then there's the claims process. This is where the rubber meets the road. When you insure a pool of high-risk drivers, you have to expect a higher number of claims. It's a statistical certainty. A standard insurer might pride themselves on a smooth, like it never even happened claims process, because their business model relies on long-term customer retention and a reputation for reliability. Non-standard insurers operate under a different incentive structure. Their goal is to minimize payouts, or what's known in the industry as loss adjustment expenses. This means claims investigations can be far more rigorous. They will scrutinize every detail of an accident report, looking for any inconsistency, any reason to deny or reduce a claim. Was the driver who crashed the car explicitly listed on the policy? If not, the claim is often denied. This is called a named driver policy, a common feature in the non-standard market that's almost unheard of in the standard world. With a standard policy from Geico, if you let your responsible friend borrow your car, and they have an accident, you're generally covered. With many non-standard policies, if that friend's name isn't printed on the policy document, you are completely on your own. It's a brutal piece of fine print that has financially ruined countless unsuspecting policyholders. And what about that piece of paper that proves you're legal? For many drivers, it comes with a special designation, the State Route 22. And State Route 22 is an insurance. It's a form, a certificate that the insurance company files with the state on your behalf. It's the state's way of keeping a short leash on you, forcing you to prove you have continuous insurance coverage, typically after a major violation like a DUI or driving without insurance. If you cancel your policy or miss a payment, the insurance company is legally required to immediately notify the state, which will then suspend your license again. For non-standard insurers, the State Route 22 is a river of gold. Mainstream companies often refuse to file SR22s, or they charge an exorbitant amount to do so. They simply don't want the hassle or the high-risk client that comes with it. This creates a captive market. If a judge tells you that you need in State Route 22 to get your license back, you can't go to just any insurer. You have to go to a company that specializes in them. Companies like Direct General become one of the few games in town. They can charge a filing fee for the State Route 22, and they have a customer who is now terrified of letting their policy lapse, ensuring a more consistent stream of those high, fee-laden monthly payments. So you have a business model built on a legally mandated bare-bones product. It profits not just from high premiums but from financing those premiums. It controls its costs by capping its liability at low state minimums and employing a far more stringent, and at times adversarial claims process. And it benefits from a legal system that funnels its most desperate customers, those needing in State Route 22, directly to its doorstep. This isn't an accident. It's a brilliantly engineered system. It's a machine designed to serve a population that the rest of the market has abandoned, while simultaneously extracting maximum value from their precarious circumstances. The bright yellow signs and the friendly neighborhood offices are the user interface for a complex financial engine. It promises a simple solution: get legal for less. But the contract you sign is anything but simple. It's a web of exclusions, conditions, and fees, designed to protect the company far more than it protects you. So you sign on the dotted line, you pay your high down payment in your first steep monthly installment. You get your proof of insurance and the State Route 22 is filed. For the first time in months, you are legal. You can drive to work without the constant fear of being pulled over and having your car impounded. Feels like a lifeline. But what happens the moment you actually need to use the insurance you're paying so much for? What happens when you hear the sickening crunch of metal and glass? That is the moment the true nature of the non-standard contract is revealed. And for millions of Americans, it's a moment of devastating realization. Let's paint a picture. It's a Tuesday afternoon. You're driving home thinking about dinner. The light turns green. You ease into the intersection, and from your left, a blur of red metal. You don't even have time to brace. The impact is violent, a percussive blast that shatters the mundane rhythm of your day. Your world is a chaotic symphony of screeching tires, crunching steel, and the spider-webbing crack of your windshield. Airbags deploy with a chemical hiss, filling the cabin with a strange, acrid smoke. For a moment, there's only a ringing in your ears. You're shaken, bruised, but you seem to be okay. The other driver is too. After the initial shock wears off, after the police report is filed and the tow trucks are called, a sense of relief washes over you. This is what you have insurance for. You've been paying your premium to Direct General, or the General, or whatever non-standard carrier you found diligently every single month. It wasn't cheap, but it was a price you paid for peace of mind. So you get home, take a deep breath, and you make the call. This is the moment of truth. You dial the number on your insurance card, navigate an automated phone tree that seems designed to test your patience, and finally, you're connected to a claims representative. But the voice on the other end isn't reassuring. It's distant, detached. There's no empathy, just a series of rapid-fire pointed questions. Were you using the vehicle for any business purposes? Even delivering a package for a friend? Who else lives in your household? Give me their full names and dates of birth. Can you confirm your exact mileage on the day you purchased the policy? The questions feel less like an attempt to help and more like an interrogation. You're the victim of an accident, but you feel like a suspect. This is your first red flag. You're not talking to a partner in your recovery. You're talking to a gatekeeper whose primary job is to protect the company's money, not to pay you. You're assigned a claims adjuster. You assume their job is to adjust your claim, to figure out the damages and get you paid. But in the world of non-standard insurance, the adjuster often functions more like an internal affairs detective. Their mission is to scrutinize you, your application, and your life, searching for a single thread they can pull to unravel your entire policy. They'll ask for a recorded statement. It sounds routine, but it's a minefield. Every word you say is being analyzed for inconsistencies. They'll ask you to describe the accident over and over, hoping you'll change a minor detail. They'll ask about your medical history, your employment, your daily routines. They are building a case, and it may not be a case for you. While they're grilling you, the clock is ticking. Your car is sitting in a tow yard, racking up storage fees day after day. The other driver's insurance company is already calling you, demanding payment for their client's damages. You call your adjuster for an update, but you're sent to voicemail. You email and you get an automated reply. Days turn into weeks. The process is designed to be a war of attrition. They know you're in a vulnerable position. You need a car to get to work. You're facing medical bills. They are betting that the sheer weight of the stress and the mounting costs will force you to give up, or to accept a ridiculously lowball offer that doesn't even begin to cover your losses. And then the letter arrives. It's in a crisp white envelope, filled with dense legalistic language. But you don't need a law degree to understand the two most important words: claim denied. And the reason they give is the most common and devastating weapon in the non-standard arsenal: material misrepresentation. What is that? It's a legal term for a lie or omission on your insurance application that, had the company known about it, would have caused them to charge a higher premium or not issue the policy at all. And these companies will dig. They will pull records you didn't even know existed to find one. Remember when you signed up for the policy online? You were trying to get it done quickly. There was a question. Do you ever use your vehicle for commercial purposes? You clicked no. Of course not, you have an office job. But what about that one Saturday you delivered for DoorDash to make a few extra bucks? To the insurance company, that's commercial use. Your policy is void. Or maybe the application asks for all licensed drivers in your household. Your 19-year-old son is away at college and doesn't have a car, so you didn't list him. To the insurance company, he is a licensed driver in your household. Material misrepresentation. Your policy is void. Maybe you estimated you drive 10,000 miles a year, but your last 2 oil changes suggest you actually drove 12,000. Material misrepresentation. Policy void. Can be something you never would have imagined. They might discover a speeding ticket from 5 years ago that you honestly forgot about. They might find out you occasionally park your car on the street instead of the garage you listed on your application. These seem like trivial details, but to an insurer looking for an exit, they are golden tickets. They have found their loophole. They get to keep all the premiums you paid them over the months or years. And they don't have to pay a single penny for your totaled car, your medical bills, or the brand new SUV you crashed into. This is the devastating realization. The contract you signed wasn't a safety net. It was a tripwire. The entire business model for many of these companies is built on this premise. Collect premiums from a high-risk pool of drivers, and then use a labyrinth of exclusions, technicalities, and aggressive investigative tactics to deny as many claims as legally possible. They are not selling protection. They are selling a piece of paper that keeps you legal on the road and nothing more. and they are betting that you, the average person, won't have the time, the money, or the energy to fight them. So now what? Your claim is denied. Your car is a wreck. And the other driver? Their insurance company isn't just going to forget about it. They paid to fix their client's car. And now they are coming after you personally to get that money back. They will send letters from law firms. They will sue you. They can garnish your wages. They can put a lien on your property. Suddenly, a car accident has turned into a full-blown financial catastrophe that could haunt you for years. You did what you were supposed to do. You bought insurance. You paid for it. And when you needed it, the company vanished, leaving you alone to face the fallout, holding a worthless policy and a bill for tens of thousands of dollars. You feel powerless, trapped, and utterly betrayed. But what these companies don't count on is when a policyholder decides to fight back. And the first step in that fight is understanding the one document they hope you never read closely: the policy declaration page. The policy declaration page. It sounds boring, bureaucratic, like something you'd use as a coaster. But in reality, it is the single most important document in your relationship with your insurance company. It's the Rosetta Stone that translates their legal jargon into plain English. It's the executive summary of every promise they've made to you, and more importantly, every promise they haven't. This single sheet of paper, often just the first page of a thick packet, is where the truth lives. It's where the $7 a day premium you saw on that billboard gets exposed for the paper-thin shield it really is. Let's break it down piece by piece. At the very top, you'll see your name and address. This is the named insured. This seems obvious, but the trap is already being set. Who else drives your car? Your spouse? Your kid who just got their license? A roommate who borrows it for groceries? In the world of non-standard insurance, assumptions are expensive. Some policies are so restrictive they only cover the people explicitly listed on this page. If your son, who lives with you but isn't listed, wrecks the car, the company could argue he's not a covered driver and deny the entire claim, leaving you holding the bag for thousands, or even hundreds of thousands, in damages. They'll happily take a premium that accounts for a multi-driver household, but when it's time to pay, they'll point to this one line and wash their hands of you. Next, you'll see the policy period. A start date and an end date, usually a 6-month or 1-year term. This is your window of protection. If you have an accident 1 minute before the policy starts or 1 minute after it expires, you are on your own. And don't fall for the myth of the grace period. Many non-standard companies offer no grace period at all. If your payment is due on the 5th and you pay on the 6th, they can cancel your policy. And if you had an accident that morning, you're uninsured. They might reinstate you after you pay, but that reinstatement often starts from the moment you paid, not retroactively. That gap, that little window of a few hours or a few days, is a canyon of financial ruin they are perfectly happy to let you fall into. Then comes the list of covered vehicles. Your car's make, model, year, and the most critical piece of information: the 17-digit vehicle identification number, the VIN. You must check this. You must check it twice. I have seen claims denied because a single digit in the VIN was wrong on the declaration page. The driver paid his premiums for 3 years, got into a major accident, and the company's response was essentially, "We're sorry for your accident, but the vehicle you were insuring, according to this VIN, was a blue Ford F-150. The vehicle that was wrecked was a black Ford F-150. We never insured that vehicle." A simple typo, maybe made by the agent or an administrative assistant, becomes the perfect excuse to pay you nothing. It's a get-out-of-jail-free card for them, and a life sentence of debt for you. Now we get to the heart of the matter: the coverages. This is the section that looks like a menu from a strange restaurant, with weird names and numbers next to them. This is where the shell game is played. You'll see a line for bodily injury liability. This is the money that pays for the people you hurt in an accident you cause. Next to it, you'll see 2 numbers like 25/50. This means the company will pay a maximum of $25,000 for any single person's injuries, and a maximum of $50,000 for the entire accident, no matter how many people are hurt. Let that sink in. $25,000. Have you seen a hospital bill lately? A single night in the emergency room and MRI, a few stitches, that can easily exceed $25,000. What if you cause an accident that results in a serious injury requiring surgery and physical therapy? The medical bills could be $150,000. Your legal insurance policy will pay the first $25,000, and then the injured person's lawyer will come after you for the remaining $125,000. They will garnish your wages. They will put a lien on your house. They will seize your assets. Your life as you know it will be over, all because you were sold a policy that was designed to fail. Then there's property damage liability. You might see a number like $10,000 or $15,000. This is to fix or replace the other person's car or property that you damage. The average price of a new car in America is now over $48,000. You rear-end a brand new Honda CR-V and total it. Your policy pays $15,000. Who pays the other $33,000? You do. For the rest of your life if necessary. You see, these non-standard companies aren't selling you protection. They are selling you a piece of paper that keeps you from getting a ticket. They are satisfying the legal requirement for the state, but they are doing nothing to satisfy the financial reality of an actual accident. It is a compliance product, not a protection product. And what about protecting you? That's where it gets even worse. You'll see lines for uninsured or underinsured motorist coverage. This protects you if you're hit by someone with no insurance or someone with one of these same junk policies. It pays for your medical bills, your lost wages, your pain and suffering. This is one of the most important coverages you can have. And non-standard companies will do everything in their power to get you to reject it. They'll have you sign a waiver, telling you it'll save you $8 a month. They prey on your desire for a lower price, knowing they're tricking you into stripping away your own armor. It's a cynical, calculated move to reduce their own risk, and it leaves you completely exposed. Then you have collision and comprehensive. People call this full coverage, but that term is a dangerous lie. There is no such thing as full coverage. Collision pays to fix your car if you hit something. Comprehensive pays for things like theft, fire, hail, or a deer strike. But here's the catch: the deductible. The declaration page will list your deductible, which might be $500, $1,000, or even $2,500. This is the amount of money you have to pay out of your own pocket before the insurance company pays a dime. If you have a $1,000 deductible and $1,200 in damage, you'll go through the entire stressful claims process just to get a check for $200. These companies love high deductibles because they know most people can't afford to pay them, so they never file the smaller claims, saving the company millions. But the most sinister part of the declaration page is often at the very bottom, in a section called endorsements or riders. These are modifications to the policy. Think of them as the secret rules and exceptions. In the world of non-standard insurance, these are almost exclusively used to take coverage away. You might see an endorsement called a named driver exclusion. It will list a person by name, let's say your 19-year-old son, and state that if that person is driving your car, there is absolutely no coverage. Not for your car, not for the car they hit, not for the people they injure. Nothing. It's as if you had no insurance at all. You might see a business use exclusion, which says if you're using your car for any commercial purpose, delivering for DoorDash, driving for Uber, even just dropping off packages for your job, your coverage is void. Or a custom equipment exclusion, meaning those new wheels and that sound system you installed are worthless in their eyes. They'll replace them with factory parts if they replace them at all. These endorsements are a minefield, designed to create technicalities that allow the company to deny your claim, even when you've done nothing wrong and have paid your premium on time, every single month. This one page is their entire strategy laid bare. It shows you the low limits, the high deductibles, and the crippling exclusions. It is a map of your own financial vulnerability. They are betting you won't read it. They are betting you won't understand it. They are betting that you'll just see the low price, sign on the dotted line, and file it away until it's too late. But now you know what to look for. You know the questions to ask. This isn't just paperwork. It's your first line of defense. But understanding what the policy says is only half the battle. What happens when you actually need to use it? When you're standing on the side of the road, heart pounding, and you dial that 1-800 number on your insurance card. That's when you graduate from being a customer to being a liability. You enter a carefully constructed system designed to frustrate you, confuse you, and ultimately, pay you as little as legally possible. Their adjusters have a script, a psychological playbook, to use against you from the very first call. And in the next part, we are going to tear that playbook wide open. The moment your phone rings and you see an unknown number, just days or even hours after the crash, the game begins. You answer and you're greeted by the friendliest, most empathetic voice you've ever heard. This is the adjuster from the other driver's non-standard insurance company, like Direct General. And page 1 of their playbook is called The Disarming. They will sound like your best friend. They'll ask how you are, express deep sorrow for what you've been through, and assure you that their one and only goal is to make this right and get everything taken care of for you as quickly as possible. This is a carefully crafted psychological tactic. They are building rapport. They want you to lower your guard. They want you to believe they are on your side, an ally in this confusing process. Because a person who trusts you is a person who will talk. And that's when they spring the single most dangerous trap in the entire claims process, the recorded statement. They'll present it as a harmless formality. I just need to get your version of events on a recorded line for our file. They'll say, it'll only take a few minutes. It just helps us speed things up. This sounds reasonable. You want to be helpful. You want to speed things up. So you agree. And in that moment, you have handed them the ammunition they need to dismantle your claim. A recorded statement is not for your benefit. It is a strategic interrogation designed for one purpose: to find any reason, no matter how small, to devalue or deny your claim. The questions seem innocent, but every single one is a landmine. They'll start with, how are you feeling today? It's a natural human question. If you're like most people, you'll instinctively say, I'm okay, or I'm fine, thanks. Congratulations. They now have you on a recorded line, just days after a major accident, stating that you are fine. Later, when your doctor diagnoses you with whiplash, a concussion, or soft tissue injuries that took a few days to fully manifest, they will play that recording back. But on day 2, you told us you were fine. These medical bills seem excessive for someone who was fine. Then they'll ask, can you just tell me in your own words what happened? This open-ended question is a masterpiece of manipulation. It encourages you to talk, to speculate, to guess. You might say something like, well, I was looking at my GPS for a second, and then I looked up and boom, he just came out of nowhere. You've just admitted to being distracted. You might say, I'm so sorry this whole thing happened. They will interpret that as an admission of guilt. You might say, I probably could have braked a little sooner. You've just admitted partial fault. They will comb through every word, every hesitation, every looking for inconsistencies between your story and the police report, or even inconsistencies within your own statement. They'll ask you about prior injuries, even from a decade ago, to argue that your current pain is from an old problem. They'll ask you to describe the damage to your car in detail, hoping you'll downplay it, which they'll then use to argue the impact wasn't severe enough to cause your injuries. This isn't a conversation. It's a deposition where you have no legal counsel, you're likely in pain or on medication, and you're up against a trained professional whose entire job is to pay you as little as possible. Once they have your statement, page 2 of the playbook begins, the great stall. The friendly, let's get this done quick adjuster suddenly becomes very, very busy. Your calls go to voicemail. Your emails get automated replies. When you do get them on the phone, the answer is always the same. We're still investigating. We're waiting on the police report. We haven't been able to get a statement from our insured driver yet. This is not incompetence. This is a weapon. It's called the delay tactic, and it's designed to bleed you out. They know your car is wrecked. They know you need it to get to work. They know the medical bills are starting to arrive in your mailbox. They know you're in pain, stressed, and that your life has been turned upside down. They are using your own desperation against you. The longer they wait, the more pressure builds on you. You become financially and emotionally exhausted. You just want it to be over. And that's exactly when they move to page 3, the lowball offer. After weeks, maybe months of silence and frustration, the adjuster finally calls back. Their tone has changed. The empathy is gone. Now it's all business. Okay, they'll say. Based on our complete investigation, we can offer you $2,000 to settle your claim today. You're stunned. Your medical bills alone are $5,000. Your car repairs are $3,000. You missed a week of work. $2,000? That doesn't even cover my visit. And they'll have an answer for everything. Well, according to your recorded statement, you admitted you were looking at your phone, so we've determined you were 30% at fault. And you said you were fine the day after the accident, so we don't believe these extensive medical treatments were necessary for this minor impact. The $2,000 is our full and final offer. What they've just done is use a psychological tactic called anchoring. By throwing out that absurdly low number, they have anchored the negotiation. Your brain is no longer thinking about the $10,000 your claim is actually worth. Your brain is now forced to negotiate up from their $2,000 anchor. Any number that's higher than $2,000 now seems like a win, even if it's still thousands less than you deserve. This is the moment the entire strategy has been building towards. You're tired. You're frustrated. You're in debt. and they are offering you a check right now today. This is page 4, the squeeze. This is a one-time offer, they might say. If you don't accept it, we'll have to take it to litigation, and that could take years. You could end up with nothing. They are manufacturing a sense of urgency and fear. They are preying on the exhaustion they themselves created with the delay tactic. They want you to feel trapped, like this paltry sum is your only way out of the nightmare. This playbook is especially brutal and effective in the non-standard insurance world. These companies know their customers, and the people their customers hit often have fewer resources. They may not have a rainy day fund to cover a rental car or pay a medical bill. They may not know a lawyer or even realize they can hire one. They are the most vulnerable. And this playbook is designed to exploit that vulnerability to its absolute limit. It is a system of psychological warfare designed to grind you down, confuse you, and force you to surrender your rightful claim for pennies on the dollar. They have a script, but what they don't count on is you having one too. They expect you to be emotional, unprepared, and uninformed. They don't expect you to know the game. But now you know their playbook. You know the traps. So the question is, how do you beat it? How do you flip the script, avoid the landmines, and force them to treat you fairly? That's the counter playbook. And we're opening it up in the very next part. The first rule of the counter playbook is this. The game begins the second the accident happens, not when you file the claim. Every single thing you do from that moment forward is a move on the chessboard. The insurance company has their first move planned. You need to have yours planned too. Their goal is to control the information. Your goal is to seize it. So, the first countermove is to become a relentless, obsessive, forensic-level documentarian. The moment you are safe and out of harm's way, your phone is no longer a phone. It is the most powerful evidence-gathering tool you own. You are going to take more photos than a wedding photographer. Start wide. Get the entire scene from all 4 corners of the intersection or stretch of road. Get the street signs, the traffic lights, the weather conditions. Is the sun in someone's eyes? Is the road wet? Document it. Then you move in closer. Take pictures of all vehicles involved from every conceivable angle. Front, back, both sides, and all 4 corners. Now get microscopic. The damage. Don't just take one picture of the dented bumper. Take 20. Get close-ups of the scratches, the cracked plastic, the bent metal. Get photos of the other car's damage with the same level of detail. Why? Because you are creating a visual record so complete, so undeniable, that it leaves zero room for an adjuster sitting in a cubicle 500 miles away to later claim the damage was pre-existing or that the impact couldn't have caused that kind of dent. You are preemptively dismantling their arguments before they can even make them. And then you switch to video. A slow, steady walk-around of the entire scene. Narrate what you are seeing. This is my car. This is the other driver's car. The impact happened right here. This video is your unshakable memory. Weeks later, when details get fuzzy, this recording will be crystal clear. If there are witnesses, you must get their contact information. Name and phone number minimum. If they are willing, ask them, would you mind if I took a 30-second video of you just explaining what you saw? Most people will say no, but if one person says yes, that independent third-party account is absolute gold. It can neutralize a he said, she said situation instantly. Finally, no matter how minor, no matter if the other driver is the nicest person in the world and says, let's just handle this between us. You call the police and file a report. An official police report is a foundational document. It's an objective, state-sanctioned record of the event. It forces a version of the facts onto paper that is much, much harder for an insurer to dispute than just your word against their clients. Now for the second countermove. Controlling the first contact. You've gathered your evidence. Now you have to report the claim. The adjuster will call you, and they will be friendly, empathetic, and reassuring. Their one and only goal on this first call is to get you to agree to a recorded statement. We've talked about this trap. Here's how you disarm it. When they ask, I just need to get a brief recorded statement to process your claim, you will be prepared. You will calmly and politely say, I can provide you with the facts of what happened, but I'm not comfortable giving a recorded statement right now. They will push back. They'll say, it's just standard procedure. Or we can't move forward without it. This is a bluff. You hold your ground. I understand. I will be sending you a written summary of the events, along with the police report number. Let's start with that. Or another powerful option. I'd be happy to provide a statement once I've had a chance to review the full police report and my policy documents. I will let you know when I am ready. You are not refusing to cooperate. You are being prudent. You are being careful. This simple act signals to the adjuster that you are not a typical, flustered victim. You are organized, you are deliberate, and you will not be rushed into making a mistake. You have just taken control of the most critical part of the information gathering process. This leads directly to the third, and perhaps most important countermove. Create an obsessive paper trail. From this point forward, every single phone conversation you have with anyone from the insurance company, the adjuster, their supervisor, a claims agent, is immediately followed up by an email from you. Call it a confirmation of conversation email. It's simple, professional, and devastatingly effective. It looks like this: "Hi, adjuster's name. Per our phone conversation a few minutes ago, I just want to confirm my understanding. We discussed that the next step is for you to review the photos I sent, and you expect to have a preliminary estimate for me within 48 hours. Please let me know if any of this is incorrect. Thank you." What have you just done? You've taken a fleeting, deniable phone call and turned it into a hard, documented record. You've created a timeline. You've established accountability. When the adjuster fails to meet that 48-hour deadline, you don't have to argue about what was said. You have the email. You have the proof. This single habit transforms the entire dynamic of the claims process. It prevents them from making promises they don't keep, from changing their story, or from claiming you misunderstood them. You are building a case file brick by brick that shows you are methodical and serious. Adjusters are trained to triage claims. They put the disorganized, passive, easy-to-manage claims on one pile, and the organized, documented, difficult ones on another. Your goal is to get into that second pile as quickly as possible. Finally, countermove number 4. Reject their reality and substitute your own. This is about the damage estimate. After you submit your claim, the adjuster will either come out to see your car or, more likely, have you submit photos for a virtual estimate. The number they give you will almost certainly be low. It will be based on the cheapest possible parts and the lowest possible labor rates. They will then strongly recommend you take your car to one of their preferred network shops. They'll tell you it's faster, the work is guaranteed, and it's hassle-free. Do not do it. In most states, it is your legal right to have your vehicle repaired at the shop of your choice. A preferred shop has a primary relationship with the insurance company, not with you. Their incentive is to keep the insurer happy by keeping costs down, which often means using aftermarket or even salvaged parts instead of original equipment manufacturer, or OEM parts. Here's the counterplay. Before you even get their estimate, you do your own homework. You find 2 highly rated independent body shops in your area. You take your car to them and get your own written estimates. You specifically ask them to write the estimate using only OEM parts. Now, when your insurance adjuster comes back with their lowball offer of, say, $2,000, you don't argue. You don't get angry. You simply reply, "Thank you for that. I have here 2 estimates from certified repair facilities, and they've both quoted the repair at around $4,000 using OEM parts as required to restore the vehicle to its pre-loss condition. Can you please explain the $1,200 discrepancy?" See what happened? The burden of proof just shifted. You are no longer trying to justify why you deserve more money. You are forcing them to justify why they are offering so little. You've bracketed them with independent, expert data. You've taken their fictional, lowball number and confronted it with real-world facts. Through these 4 countermoves: maniacal documentation, controlling the statement, creating a paper trail, and securing independent estimates, you have completely flipped the script. You are no longer a supplicant asking for help. You are a project manager, directing your own claim with precision and evidence. You've built a fortress of facts around your case. But what happens when, despite all of this, they still refuse to budge? What happens when they deploy the soul-crushing strategy of delay, deny, and defend? When they just ignore your emails, miss your deadlines, and refuse to negotiate in good faith? This is when the playbook enters its final, most serious phase. This is when you stop asking nicely and start using the system's own leverage against it. And that escalation strategy is exactly what we're breaking down next. First, you draft what's known as a formal demand letter. This is not another email. This is not another phone call begging for a supervisor. This is a meticulously crafted document, sent via certified mail with a return receipt, that officially puts the insurance company on notice. It is the legal equivalent of drawing a line in the sand. In this letter, you are no longer a claimant. You are a potential plaintiff. Your tone shifts from cooperative to assertive. You will state the facts of the case, clearly and without emotion. You will reference the specific evidence you have: the police report, the photos, the repair estimates, the medical bills. You will cite the other driver's policy number and your claim number. Then comes the most important part, the demand. You state in no uncertain terms the exact dollar amount you are demanding to settle the claim. This isn't a negotiation starting point. This is your calculated, evidence-backed figure for your total damages. And you give them a deadline, a firm, non-negotiable deadline. You have 15 days or 30 days to respond to this demand with a satisfactory settlement offer. Finally, you end with the consequence. Failure to resolve this matter within the specified timeframe will leave me with no alternative but to pursue all available legal remedies, including but not limited to filing a formal complaint with the State Department of Insurance and initiating legal action for the full amount of my damages, plus interest, court costs, and potential bad faith claims. This letter changes everything. It creates a paper trail that a judge or a regulator can follow. It shows you are serious, organized, and aware of your rights. Often, this alone is enough to get a low-level adjuster supervisor to pick up the phone and suddenly find the money they claimed didn't exist. But what if they call your bluff? What if they ignore the letter or come back with another insulting lowball offer? Now, you pull the pin on the first grenade. You file a formal complaint with your state's Department of Insurance, or DOI. Every single state has one. This is the government body that licenses and regulates insurance companies. They are the industry's watchdog and they have teeth. Insurers like Direct General pay massive fees to be licensed in a state, and the last thing they want is the DOI investigating their business practices. A high number of complaints can trigger audits, fines, and in extreme cases, a revocation of their license to operate. Filing a complaint is usually free and can often be done online through the DOI website. You will provide all the same information from your demand letter: the facts, the evidence, your claim number. But here you frame the narrative differently. You are not just asking for your claim to be paid. You are reporting the company for potential violations of your state's Unfair Claims Settlement Practices Act. You use key phrases: unreasonable delay in settling a claim, not attempting in good faith to effectuate a prompt, fair, and equitable settlement, compelling me to initiate litigation to recover amounts due under the insurance policy by offering substantially less than the amounts ultimately recovered. These aren't just your opinions. These are often direct quotes from state law defining what an insurance company cannot do. Once you file that complaint, the game changes. The insurer is now legally obligated to respond, not just to you but to the government regulator. They have to assign a senior-level employee to write a formal response explaining their actions. Suddenly, your little claim that was being ignored is on the desk of someone whose job is to keep the company out of trouble with the state. This creates immense internal pressure. The DOI will review their response and your evidence and issue a finding. While they might not be able to force a specific payout, a finding in your favor gives you a golden ticket, an official government document stating the insurer did not handle your claim properly. This is ammunition, powerful ammunition for the next step. This brings us to the biggest fear of any insurance company, the one thing their lawyers have nightmares about: an accusation of bad faith. Insurance is not like any other business. When you buy a policy, you are not just buying a product, you are entering into a special contract. The law recognizes that there is a massive power imbalance between a giant insurance corporation and an individual policyholder or claimant. Because of this, the law imposes a special duty on the insurer, a duty to act in good faith and fair dealing. They can't just look for loopholes to deny a valid claim. They have to investigate it fairly. They have to value it honestly. They have to communicate with you properly. When an insurer unreasonably and without proper cause withholds the benefits of the policy from you, they are not just breaching a contract. They are committing a tort, a civil wrong, called bad faith. And here's why that's so terrifying for them. If you sue them for just the value of your claim, say $10,000 for your car repairs, the most you can win is $10,000. But if you sue them for bad faith, the damages can explode. You can sue for the original $10,000 plus emotional distress plus attorney's fees. And this is the big one: punitive damages. Punitive damages are not designed to compensate you for your loss. They are designed to punish the company for its egregious behavior and to deter it from doing the same thing to other people in the future. These damages can be multiples of the original claim amount, sometimes running into the hundreds of thousands or even millions of dollars. A $10,000 claim can turn into a $250,000 lawsuit. This is the leverage you hinted at in your demand letter. The threat of a bad faith lawsuit is the reason a senior claims manager will look at your file, see the DOI complaint, see the certified letter, and realize that playing hardball with you is no longer a cost-saving measure. It's a massive financial risk. At this point, you are at a crossroads. The demand letter, the DOI complaint, and the threat of a bad faith suit are your heavy artillery. You've fired your warning shots. If the insurer still refuses to offer a fair settlement, it's time to bring in a professional. It's time to hire an attorney. Many people hesitate here. They think, I can't afford a lawyer. But for this type of case, you almost never pay out of pocket. Personal injury and insurance bad faith attorneys typically work on a contingency fee basis. This means their fee is a percentage of the money they recover for you. If they don't win you a settlement or a verdict, they don't get paid. Period. This system aligns their interests perfectly with yours. They have every incentive to fight for the maximum possible recovery because their payment depends on it. An experienced attorney knows the local judges, they know the opposing counsel, and most importantly, they know the true value of your claim. They can hire experts, take depositions, and force the insurer to turn over internal documents that can prove a pattern of bad faith. The moment an attorney files a notice of representation, the insurance company knows the game is over. The claim is immediately escalated to their legal department, and the conversation changes from, if we will pay, to, how much we will pay to make this go away. Now, for smaller claims, maybe your damages are only a few $1,000s, hiring a lawyer on contingency might not be feasible. This is where the final tool in your arsenal comes into play: small claims court. Think of it as the people's court. The rules are simplified, you don't need a lawyer, and the process is much faster and cheaper than a full-blown lawsuit. Each state has a limit on how much you can sue for in small claims, typically ranging from $5,000 to $25,000. If your claim falls within that limit, you can file the paperwork yourself for a small fee, serve the insurance company, and have your day in front of a judge. You present your evidence, the police report, the photos, the estimates, your demand letter, the response from the DOI. The insurance company will have to send a representative, often a lawyer, to defend their position. But now they have to justify their lowball offer not to you, but to a neutral judge who is not impressed by their delay tactics. More often than not, the mere act of being served with a small claims lawsuit is enough to get the insurer to finally write the check. It's simply not worth their time and money to pay a lawyer to show up in court over a claim they know they are going to lose. From the demand letter to the DOI, from the threat of bad faith to the power of the courts, you are never without options. You are never powerless. You simply need to know the rules of the game and be willing to use them. These steps transform you from a victim of the system into a master of it. But knowing the steps is only half the battle. Executing them perfectly, and knowing how to navigate the final stages of a lawsuit or settlement negotiation, that's where the real art lies. And that's the final piece of the puzzle we need to put in place. But the final negotiation is not a conversation. It's a chess match. It's a high-stakes poker game where the insurance company has a deep stack of chips and has played thousands of hands before you even sat down at the table. They know every trick, every tell, every psychological lever to pull to make you fold. Your only advantages are the strength of your evidence and the strength of your resolve. The moment a settlement negotiation begins, you need to understand one fundamental truth. The first number they put on the table is an insult. It's not designed to be a starting point for a fair discussion. It's designed to re-anchor your expectations to rock bottom. They might offer to cover your initial medical bills and throw in a few thousand for your trouble. This offer is a test. It's designed to see if you're desperate, if you're uninformed, and if you're willing to go away cheap. Your response to this lowball offer sets the tone for the entire rest of the negotiation. A weak, emotional response signals that you can be pushed around. A strong, evidence-based response signals that you mean business. This is where your meticulous record-keeping pays off. You don't just say, I want more. You present a formal demand letter. This isn't just a letter. It's a meticulously crafted legal argument. It retells the story of the accident, establishing clear liability. It includes an exhaustive list of every single economic cost. Every doctor's visit, every prescription, every physical therapy session, every dollar of lost wages, every projected future medical expense backed by expert opinion. Then it moves to the non-economic damages, the pain, the suffering, the sleepless nights, the lost enjoyment of life. You don't just pull a number out of thin air. You justify it, often by using a multiplier based on the severity of your economic damages. You attach every bill, every report, every piece of evidence. You are not asking for money. You are presenting an ironclad case for damages you have already incurred and will continue to incur. This demand letter forces the adjuster to take you seriously. They can no longer pretend this is a minor issue. They now have a formal demand in their file that they must respond to. And so the dance begins. They'll come back with a second offer, higher than the first, but still nowhere near what you've demanded. They will nitpick your demand. They'll question the necessity of a certain medical treatment. They'll argue you were out of work longer than necessary. They'll claim your pain and suffering calculation is wildly inflated. Every single argument is a tactic designed to make you doubt the value of your own case. They want you to get tired. They want you to get frustrated. The delay is not an accident. It's a strategy. They know that the longer this drags on, the more financial pressure you're under, and the more likely you are to accept a lower offer just to make it all stop. Patience becomes your greatest weapon. Responding to their arguments with more evidence, holding firm on your valuation, and showing them that you are prepared to wait them out is critical. This back and forth can take months, but eventually you will reach a crossroads. The insurance company will make what they call their final offer, and you are faced with one of the most difficult decisions of the entire process. Do you take the settlement, or do you take your chances in court? This is not a decision to be taken lightly. Settling offers certainty. The number might not be everything you wanted, but it's a guaranteed amount of money. The case is over. You get a check, usually within 30 to 60 days, and you can close this chapter of your life and move on. There are no more legal fees piling up. No more depositions. No more stress of a looming trial. It's clean, it's private, and it's final. Going to trial, on the other hand, is the ultimate gamble. It's betting everything on the belief that 12 strangers in a jury box will see the world exactly as you do. The potential upside can be enormous. Juries can and do award verdicts that are many times higher than the insurance company's final settlement offer. A trial offers the chance for public vindication, to have your story heard and validated in a court of law. But the risk is catastrophic. A trial is an incredibly expensive, emotionally draining, and public ordeal. You will be cross-examined by a skilled attorney whose only job is to discredit you, to pick apart your story, and to portray you as greedy or dishonest. And after all of that, the jury could come back and award you less than the settlement offer. Or, in a nightmare scenario, they could award you nothing at all. You could walk away with absolutely zero, and still be on the hook for massive legal costs. The sure thing of the settlement is gone forever. You rolled the dice and lost. Let's say you decide to accept the final offer. The insurance company agrees to pay. You might think you just pop a bottle of champagne and wait for the check. But you're not done yet. You're about to enter the most legally treacherous part of the entire process: signing the settlement and release agreement. This document, which can be dozens of pages long, is written entirely by the insurance company's lawyers for one purpose: to protect them, not you. Buried in the legalese are clauses that can have life-altering consequences if you don't understand them. The first is almost always a confidentiality clause or an NDA. This legally forbids you from ever discussing the amount of money you received or the facts of your case with anyone. Why? Because the last thing an insurance company wants is for the next person in your shoes to know what they were willing to pay. It gives them a massive advantage in future negotiations. But the most critical part is the release of all claims. When you sign this, you are extinguishing your right to ever seek more money from the at-fault party or their insurer for this incident, for any reason, for the rest of time. It is absolute and final. Imagine you settle your case for a back injury. You sign the release, you cash the check. A year later, you find out the injury was far more severe than doctors initially thought, and you now need a complex $100,000 surgery. It doesn't matter. You have released them from all claims, known and unknown, that arose from that accident. You cannot go back for more money. The door is closed and locked forever. And then comes the part that blindsides so many people: liens and the principle of subrogation. You see a settlement number. Let's say it's $100,000, and you think that's what you're getting. But it's not. Before you see a single penny, other parties get to take their cut. First, your attorney's contingency fee comes off the top, typically a third, or $33,000. Then the case expenses they fronted, for things like expert witnesses, court filing fees, and deposition transcripts, are deducted. That could be another $5,000 or $10,000. But the biggest surprise is the liens. If your health insurance company paid for your medical treatment, they have a legal right to be reimbursed from your settlement. This is called subrogation. If they paid $50,000 in medical bills, they will place a $50,000 lien on your settlement. The same goes for Medicare, Medicaid, or even your own car insurance company if they paid out under a MedPay or PIP policy. Suddenly, your $100,000 settlement looks very different. After the $33,000 attorney's fee and say $7,000 in costs, you're at $60,000. Then you have to pay back the $50,000 health insurance lien. You are now left with just $10,000 from a $100,000 settlement. This is a brutal reality that many people are not prepared for. A skilled attorney will spend a significant amount of time negotiating these liens down, trying to get the health insurer to accept a smaller percentage of what they're owed, in order to maximize the client's take-home recovery. But you must understand that the gross settlement amount is a fantasy number. The only number that matters is the net amount you put in your pocket after everyone else has been paid. Once the release is signed and the liens are resolved, the insurance company sends the check to your lawyer's office. It doesn't go to you directly. It is deposited into a special, highly regulated account called a client trust account. From there, your lawyer has a legal and ethical duty to disburse the funds correctly, first paying off their fees and costs, then paying off all the negotiated liens, and only then writing the final check to you. This process ensures that everyone who has a legal claim to a piece of that settlement gets paid before you do. It's a final sobering lesson in how the system is structured. So you've navigated the claim, the lawsuit, the settlement. You have the check in hand. But the story isn't over. The biggest long-term consequence of this entire ordeal is something we haven't even touched on yet. How this single incident will fundamentally change your relationship with insurance forever, and what you must do now to protect your future. You are now living in a completely different world. The insurance industry, which once saw you as a statistic, a simple line item in a portfolio, now sees you with a bright, flashing red label. High risk. This isn't just about paying more money. It's a fundamental shift in your status. You've gone from being a customer they compete for to a liability they have to manage. This label is like a financial shadow that follows you everywhere. It's an invisible score, more impactful than your credit score in this specific arena, and it will dictate your options for years to come. Think of it this way. Before the incident, you could walk into any insurance store on the block. Geico, Progressive, State Farm. Their doors were wide open, offering you discounts and bundles. After the incident, most of those doors quietly lock as you approach. They might not hang a sign that says, "We don't serve your kind," but their quotes will. A quote of $1,000 a month for basic liability isn't a quote. It's a polite, legally defensible way of saying go away. This is the new reality. And the official document that cements this new reality is often a piece of paper you may never even hold, but its existence will dominate your life. It's called In-State Route 22. Let's be crystal clear about what In-State Route 22 is, because the confusion around it is massive. In-State Route 22 is not insurance. It is not a type of policy. In-State Route 22 is a certificate. It's a form that your insurance company files directly with your state's DMV or Department of Motor Vehicles. It is, in essence, a guarantee from the insurer to the state that says, "We promise, on penalty of perjury, that this person, this high-risk driver, is carrying at least the state-mandated minimum liability insurance, and we will immediately notify you if they stop." It's a leash. The state has put a leash on your driving privileges, and your insurance company is holding the other end. If the court or the DMV has mandated that you need In-State Route 22, you cannot legally drive without one. Your license remains suspended until that form is on file. Here's the catch-22. You can't get In-State Route 22 without an active insurance policy, but most standard insurance companies, the ones you're used to, want absolutely nothing to do with filing In-State Route 22. It's an administrative headache and a formal declaration that they are insuring a high-risk individual, something their underwriters and risk models are programmed to avoid at all costs. This is the precise moment the non-standard insurance market becomes your lifeline. This is the world of companies like Direct General, the General, Safe Auto, and others. They aren't just willing to file In-State Route 22. It's a core part of their business model. They specialize in it. They have built their entire infrastructure around catering to the driver that the standard market has rejected. So, you call a company like Direct General. You tell them your story. You've had a major violation, you need In-State Route 22. They won't flinch. They won't give you a, "We don't want your business" quote. They'll give you a real, albeit high, quote. You'll pay your first premium, and a fee for them to file the form. They then send that State Route 22 certificate electronically to the DMV. A few days later, the DMV processes it, and your license is reinstated. You are legal to drive again. But that leash is now active. For the entire duration of your State Route 22 requirement, typically 3 years but sometimes longer, you are under constant surveillance. If you miss a single insurance payment, if your policy lapses for even 1 second, your insurer is legally obligated to immediately file another form with the DMV. This one is called in State Route 26. It's the cancellation form. The moment the DMV receives that State Route 26, your license is instantly suspended again. No warning, no grace period. You're back to square one, and often the 3-year clock on your State Route 22 requirement resets to 0. This is the most critical takeaway. When you are in the non-standard market within State Route 22, paying your car insurance premium is no longer just another bill. It is as important as rent, as essential as food. It is the single payment that stands between you driving to work and earning a living, or getting pulled over and potentially ending up back in a courtroom. So, how do you navigate this new treacherous landscape? How do you not just survive, but eventually escape it? This is your path to redemption, the plan you must follow religiously to protect your future. First, absolute, unwavering compliance. For the next 3 to 5 years, you must become the perfect customer. Set up autopay. Check your bank account to make sure the payment went through. Never, ever give your insurer a reason to send that State Route 26. This is non-negotiable. Your financial stability and your freedom of movement depend on it. Second, drive like your future is on the line, because it is. No more rolling stops. No more, it's only 5 miles over the speed limit. No touching your phone ever. You must become the most boring, predictable, defensive driver on the road. Your car is no longer just a mode of transportation. It's a test. Every single day you get behind the wheel, you are being tested. Another ticket, another at-fault accident, will not just raise your already high rates. It could make you completely uninsurable. Even in the non-standard market, it could reset your probation period. You must be flawless. Third, understand the timeline. Your journey back to the standard market is a marathon, not a sprint. The State Route 22 requirement typically lasts for 36 consecutive months. Mark that end date on a calendar. That is your first major milestone. However, the violation itself, the DUI, the reckless driving charge, will likely stay on your driving record and impact your insurance rates for 5, 7, or in some states even 10 years. The key is that after about 3 to 5 years, its weight, the impact it has on your premium calculation, begins to diminish significantly. Fourth, and this is the light at the end of the tunnel, your graduation day. The day your State Route 22 requirement is officially over, you need to call your insurer and confirm that the obligation has been met. Then you wait. You continue your perfect driving record for another 6 months to a year. Let some clean history build up. And then you go shopping. You quietly and systematically start getting quotes from the standard carriers again. You go online to Geico, Progressive, Allstate, State Farm. You fill out their forms honestly. You list the violation, you put in the date it happened. And you will see something magical happen. Where they once quoted you $1,000, they might now quote you $200. Where their websites once gave you an error message, they will now give you a Buy Now button. This is the moment you graduate. You've done your time. You've paid the exorbitant premiums. You've maintained a perfect record under the watchful eye of the state. You have proven with years of data that you are no longer the same risk you once were. You can finally leave the non-standard market behind, secure a policy with a mainstream carrier, and feel the immense financial and mental weight lift from your shoulders. Companies like Direct General serve a crucial purpose. They are a bridge over troubled water. They provide a legally required service that allows people who have made a serious mistake to continue to work, to take their kids to school, and to rebuild their lives. They are not the destination. They are the ferry you take to get back to the mainland. The ultimate lesson in all of this is that the consequences of one bad decision behind the wheel are not just legal. They are deeply and punishingly financial, echoing for years in ways most people never anticipate. Your relationship with insurance is shattered and must be painstakingly rebuilt, one on-time payment, one safe trip at a time. It requires patience, discipline, and a perfect record. But it is possible. Understanding this system, this path from high risk to preferred, is the first and most powerful step you can take. It's the difference between being a victim of the system for a decade, or being a student of it for 3 years, and then graduating back to a normal life.